Like if you look at the deals last year, there was about whatever, give or take, let's say $6 billion of buyout activity. There are only like 4 or 5 deals which are more than, 250, $300 million. Most of the deals are smaller. Potentially smaller businesses which are more nimble, can adapt a little bit faster to AI. That also becomes possible. That's a new segment, that's becoming increasingly much more accessible.
Someone could be buying an old school company, completely changing the management team and kind of hoping to get a more AI first management team and rebuilding the stack from the start. I think that's the camp we are on this particular asset. By the same time, we have done a few of these in the US where it is at up where we've backed and we've kind of done a roll up.
We see some tuck-in acquisitions happening where you can go and then buy smaller, tuck-in opportunities, given that you have a good technology lever on top.
I think one of the other trends that we are seeing is integration has become very easy. So, we own a software company, we're acquiring, they were evaluating a target, let's say a couple of years back. Now they're revisiting that. That target is on a completely different platform. Now with AI, you can complete the platform migration in just under a month. And so, tucking in many things becomes easier.
I think historically, housing finance is a very branch-led model. It's a very people-led model. It was the same 15 years ago. Open 20 branches, at 10 people branch, those 200 people will even go loans. At least we felt, could there be a branch model? Could an RM do, instead of 20 loans, 200? Could collections happen a lot through voice AI and voice agents for people going in? Could underwriting change a lot? Could underwriting go beyond just income tax filing or GST filing? There are so many alternate sources of data that even I don't know of, but those data points exist. And I think AI is helping us decomplex a lot of those workflows.
Yes, welcome to episode 6 of Moonshot Projects. Samir and Anuvrat, thanks a lot for making time out of your busy schedule. I know, Anuvrat, you've been traveling a lot and Samir, you've been quite caught up. Finally glad to connect and do this. So I'll give you a quick intro of what we are hoping to do this episode, Anuvrat and Samir. We spent a lot of time talking about AI. We talked about fundraising. We spoke about specific areas within AI. We spent one episode on voice AI. We did a few episodes on growth investing and early stage investing and how VCs are evaluating. But there's this new whole set of, we covered early and growth in a couple of our previous episodes. There's this entire new set of AI powered buyouts that's coming up, right? Usually when you do a buyout, there used to be only specific set of value creation levers. With AI, there's a lot more stuff that you could do in terms of value creation, in terms of kind of redoing some of those legacy businesses and creating operating value. So I thought it was interesting to cover what's fundamentally changing in the buyout business, both from your sourcing, underwriting, and other standpoint, as well as in the value creation kind of opportunity, right? And given how AI is evolving, what kind of new opportunities are you guys looking at? How's your frameworks changing? We see a lot of founders now building buyout platforms. There's literally a lot of activity happening in the US. I'm sure you guys know about buying out HVAC services and car washes, kind of automating a large part of that with AI. In India, we are seeing a lot of this KPO, BPO getting automated and, roll-ups in that segment as well, right? So that's the broad theme. I'm sure a lot of investors and founders who are spending time thinking through this will derive a lot of value from this episode. So having said that, maybe we'd love to get started with some intro, Anuvrat. You went from, banking to doing growth investing in a buyout fund to being pure play growth at Lightspeed. We'd just love to understand what really excited you about investing and how you ended up at Lightspeed. If you could touch a little bit about your journey, and then we'll come to Lightspeed.
Yeah, I'll just 30 seconds and a bit less. It's more about talking to me. I'm part of the team of Lightspeed in this part of the world. By default, I've always been a growth investor, and I think that's still kind of my day job, or I'd say most of the focus area, and that's the DNA. We of course are spending our time across whether it's structures, vehicles, whatever. But the broad idea is finding tech first, or I would say today in today's day and world, tech first companies and finding a way just to partner with them. It could be seed, it could be Series A, it could be a massive Series D growth round, it could be a buyout structure or a control transaction or co-joint deal. That doesn't matter for us. I think we have the vehicle, the understanding to do all of that. That kind of what function of our team is, the fund is. Fund manages north of $50 million today. Started launching a fund in value of almost 30 lakh. And I think that is still the DNA. The DNA is still to target and go for the moonshots, as the name of your podcast series is. I think that's what I think we're 100 plus investors globally across 14, 15 offices. That's what we spend our day in, day out doing.
Yeah.
My quick journey, as you rightly pointed out, I've been doing this for more than a decade now. It's an app, so I chose to come back. That was a decision. Back then, in hindsight, and even now, pro India bull, of course. Been last more than a decade just spending time on investments across sectors. I spend my time from It could be 9 a.m. consumer, 10 a.m. financial services, and 2 p.m. 2:30 blockchain. So I'm a more generalist and all over kind of the region, both India and Southeast Asia. India, Singapore, Indonesia, Australia, some more focus area. India, of course, takes
Yeah.
some 90% of the bandwidth, but
Yeah.
that's how I spend my time.
Got it. No, thanks for that detailed intro, Anuvrat. I said I was just watching this episode that you did with your friends at Premji, and there was that question that you posed about how multi-stage fund investing is evolving. What do you think makes what do you think is changing, and where are you spending most of your focus on? Right now, given that context, I'm just curious to understand what brings Lightspeeds to the buyout segment. Right, when you started out, I'm sure you did a couple of buyouts in the US. Now you're doing something in India. What are the broad thesis for Lightspeed? In my mind, is a primarily early stage fund to focus a lot more on that segment. What are the thesis going in, and how do you see that evolving?
Yeah, as I said, right, buyout is not the core practice. It's one of the practices. The way I would break our fund is we kind of claim to be a multi-stage investment. They think buyout slightly different. A buyout would think of it. I think a lot of buyout firms, and that's the right way also to do it, is are kind of not just owning control from a virtual control perspective, like owning 70, 80, 90%, but could also be kind of running the company, have a massive operating team. I think Samir maybe can elaborate a lot more on that. And they are kind of running the companies, and of course, they take an enormous amount of risk across both equity and leverage. And when those risks play out, the returns are magnificent. And when they don't, then of course you have to kind of do the hard work, roll up your sleeves. Our strategy is slightly different. I think we are still finding ways to partner with people first versus saying, you know what, we own 85% of the company or 99% of the company. We'll find the CEO. The idea is finding those founders. And in that journey, could if we are owning north of 51% to be called buyout control perspective, that's fine. But the idea is kind of more, we are calling it a more growth plus strategy. Of course, it's a full buyout. Will do those 80-90% control transactions. But again, the idea is having those people who will be the pure founders slash evangelists slash you want to call them promoters in the Indian parlance. I think that's kind of what we are focusing on. The only reason we are doing it is, I think, again, as the firm is expanding, we are also finding ways to partner with folks across strategies. I think AI is one of those point in time moments where you using a type of technology is probably one of the greatest we and in this generation. I think the last one was in obviously 30 years back, like 26 years back. And then how could we use that to kind of transform businesses? Some companies will do themselves and we'll own 5% of them, somewhere we'll own 2% of them, and somewhere we'll own 60-70% of them. So I think that's a broad idea for us.
But when you started out thinking of owning 80-90%, which was unlike of Lightspeed, was the thesis majorly AI? Now that with AI that you can do a lot more value creation.
I think for us, the thesis is AI irrespective. It doesn't matter on buyout. If there is a non-AI deal, I just don't spend my time that much these days. I think the whole focus is how are you using AI? And
Yeah.
again, they are AI for AI, that's fine. But if company doesn't say, or we do have nothing to do with AI in our internal use cases, it is kind of not something we are spending time on in any of the stage. So I would not just say that AI and buyout are kind of booming. I think for AI, all across stages, it is the founders of the companies we find and which strategy works better. Again, there are different teams who run the same those strategies, right? Like I don't do venture by craft.
Got it.
So that's how we're building it.
No, awesome. Thanks for that detail into Anuvrat. And Sami would love to get to know a little bit. I know you spend most of your time in equity, but just curious on how you came into the buyout business and how you came into equity, and would love to know on what segments do you focus within equity on.
For sure, Saurav, thank you so much for having me here today. So I lead our tech investments for EQT. EQT is a Swedish private equity fund, largest non-US PE fund. And we are, I think, again, just latching on to a little bit what Anurag said, we are also a very growth-oriented private equity fund. So we were started by the Wallenberg family. That's a large industrial family, similar to the Tata family here in India. And so a lot of the buyout mindset is focused on growth. So I spend most of my time around technology, whether it's software services or infrastructure associated with technology, with the playbook being how do we drive and accelerate growth, and how do we remove constraints that a company may have, either in a promoter construct or in a public construct, or some of those mature businesses have those kind of things. In terms of career trajectory, I think it's been building through time. So like my first investment was back in the GFC days, more gambling than investing. But you make money and you realize that this is something that you enjoy. And so it started there. I worked for a few years with Bain and Company. So looked at many companies in that in terms of different industries and sectors. And at the same time, I was using most of my spare time looking at public companies in those spaces. So it was almost like quasi equity research on the side. And so I realized that consulting is a stepping stone to private equity for me. And then the last decade, I've been in both my previous firm and now at EQT, spending time on buyouts, largely across tech. But I've also looked at pharma, consumer, some of the other adjacent sectors as well.
And Samir, with the entire new way of AI, I'm sure you're thinking a lot about what it means to you. But I'm just curious to understand what are the key things that's changing for you when it comes to buyout. Are you looking at new set of companies that is now viable because of AI and what AI can do, or within the current kind of buyouts you do? Do you see AI creating the most amount of value within the operational or the growth aspects you mentioned? I'm just curious to understand that bit. Number one. Number two, I know EQT had did a lot of initiatives on Mother Brain and actually implementing AI in your workflows. So just curious to understand how is AI fundamentally changing the buyout business for you?
So let me take both of those. So see, I think fundamentally what AI is doing is in some ways democratizing knowledge, right? So you have faster, cheaper access to intelligence. And what that means for us is that our value creation underwrite is different. Now, the implications are that, in some sectors you can have step up value creation, right? So to the point that Anuvrat was making, certain industries where maybe we were not participating earlier, we can have a very different value creation thesis. So it expands the scope of sectors. The second element of it is just the deal size, right? So there are smaller buyouts which are now possible. In the past, you needed to have larger companies to be able to deploy, let's say, a big operational pivot playbook. Now you can do that in smaller companies, right? So the type of deal is changing. And third is in certain sectors, it's also this question, right? Like, will the company survive or not? Because there is a business model risk that's emerging. And so certain industries are also moving out of that buyout cycle, right? Where in the past they may have been attractive targets, but going forward, we feel the business model cannot adapt as quickly as the technology is changing. So I think that's the broad answer. I don't think we figured it out, but that's how it's playing out in what we look at. In terms of internal technology, see, EQT is, we like to believe that we are doing a lot. So we have Mother Brain, that's the old version of what we used in the past. But the thing with AI is, it's like if you look at the buyout value chain, right, but from pipeline to diligence to value creation to exit, the two parts of the value chain where we see a lot of impact already is the pipeline and diligence. I think value creation and exits, is still TBD to be proven. A lot of things have started, but not yet sort of visualized. On the first two, we are using a lot of tools, a lot of agents. So discoverability has become very high, right? So it's almost like everybody can discover all the firms you want to know about in any sector, right? You understand a sector really fast. But the bar on judgment has increased. So how do you define your framework to be able to parse out what makes sense, what doesn't make sense? I think that is where we are spending a lot of time. The second thing it does is the buyout model may also change. So, uh, in many instances, we also partner with founders to build out businesses. Now, in the typical era, because when technology was, let's say, a little bit more flattish in terms of evolution, you would want control upfront and then build a business over time. What is happening now is because the technology cycles have compressed, there is a massive need for capital. And so there is a different buyout structure that's possible where, you very quickly get to buyout as you develop a business which has gone through, 3-4 cycles of change in a 5-year period as technology evolves, right? So it's a new paradigm of deals. I think that's going to come up again very early, but that's what we're seeing.
But so just doubling down on the one aspect that smaller deals are possible and you can get to buyout much quicker. What would that look like? Like, for example, I believe most of your buyouts previously has been $500 million to $1 billion or plus that. Now, are you saying it's around 100 million to 500 million in that range? And for a founder who's now building a business, new age AI powered businesses or a legacy business, is there a time frame where you approach them where you feel this is viable? I'm just trying to understand what it means.
So, like if you look at the deals last year, there was about whatever, give or take, let's say $6 billion of buyout activity. There are only like 4 or 5 deals which are more than 250, $300 million. Most of the deals are smaller. They're all buyouts, but they're smaller. And that's where like we have a mid-market opportunities fund that has become really active. We are seeing a lot of activity there. But essentially, smaller businesses which are more nimble can adapt a little bit faster to AI. That also becomes possible. Larger businesses continue to be our mainstay, but that's a new segment that's becoming increasingly much more accessible. and beyond technology as well, right? In the past, you would have small software companies which still were, very attractive assets. Today, I think that universe has expanded. There are many more segments where you can back a smaller company and underwrite a great value creation thesis just because you have access to AI.
Got it. Super helpful, Samir. One thing I really want to double on, both of you have spent more than a decade in investing. I'm just curious to understand when you started out investing versus now, both that, given that you've spent time and seen both some good things and probably some not so good things, plus now that AI is changing a lot, how has your investing framework changed? Like when you are taking a first call with the founder or taking a first screening call with one of your analyst associate or whatever, right? Earlier from what you used to spend a lot more time thinking about versus now. Just curious to understand how has it changed, Samir and Fred.
Maybe I can start and what you can add, but I think fundamentally what a good business looks like hasn't changed. So, one of the things we learned the hard way is that ultimately how deeply your clients depend on you is really critical, right? So whether it's switching costs or relationships or embeddedness over many years of dependencies, right? That get built through. So I think that continues to be important, and the reason it's important is once you have that, then it doesn't matter who the CEO is. It doesn't matter what you change operationally in terms of how you deliver to that client. So I think that remains true. I think the aspect that changes is, just whether a company is using AI to deliver differently for clients or deliver different use cases for them, right? So one of the two. And that's where a little bit of that differentiation is coming, right? Companies where the leadership is bought in tend to move faster. Companies where the leadership is not bought in tend to move a little bit slower. And so the importance of management that's bought in and AI literate, I think, is just much more today than it was, let's say a decade back.
Would it be right to say, Samir, that you spend more time thinking about the defensibility from what you said, given how tech cycles are compressing right now, and the management team, how they are thinking about? Would that be the top two key aspects? Of course, there's every other thing that matters to TAM, to value creation levers, etc. But would this be top two of your mind from what you said?
So I would say less defensibility, more on the offense. And you can see the differentiation in public markets also, right? Like if you just take the other tech cycles, 20 years back, HP, DXC, IBM, like these were the big giants. And then if you look at the companies today, it's a completely different universe. Those guys exist, but it's still a different universe, right? And that came about not by re-engineering just your internal operations, but by how aggressive you were in the market. So we look at it more from a client and revenue linked assessment, right? So how are you using AI to do better for your clients? I think that is more important. And if that is working, then we can do the downstream far more easily. If you're only doing the downstream and you're unable to do the upstream, then that puts a risk on the exit profile of a business.
Got it. No, makes sense. And Anvut, how has it been changing for you?
Yeah, I think Samir kind of hit the nail on the spot, right? Like I think he mentioned how much the founders, the key operators or executives, what they want to call them, how much are they bought in? I think that is very, very crucial, at least for us. I think earlier it was still more like, I think over the last 20 years, it was more like, okay, you know what, there is a new product, or you could make a new product, and it was all about who could, make faster and ship faster. I think that velocity was very important, and that could be done by a CTO or a CDO or something like that. I don't think that's changed, but I think what happened is the like we all bet on a founder slash a CE kind of a persona, right? Like the CXOs. I think it's all becomes a question of how much are they willing to go from, what, I'm running this company, to, what, I need to make it work. And if I have to make it work, then you have to roll up your sleeves. Like a question for us, for example, we ask a lot of our founders, how much time are you really spending time with AI? And it's not like go on Claude or Chat GPT and ask a question like, okay, what I'm reading about this experience better to DPC. No, like only are you generally coding, right? Are you building agents yourself? Are you using them? Do you understand the architecture of this product that you are building? Are you understanding the architecture as the CTO? Yeah, of course. You may not get in the nth level of the code. That's fine. But are you really the evangelist? And if that's not the case, I think then that gets hard for us to spend time. I think that's been kind of, I haven't got its biggest learning over the last 10 years, but I think that's become very important in the world of AI.
What is important right now?
You could have, like, I think in a pre-AI world, you could have a promoter or a founder who's less involved and more like a chairperson. And there is a very professional CEO at the show, and that works or historically has worked well. I just don't think it works in the world of AI. It will not work in the world of AI. It has to come from from the stakeholder who has the most skin in the game, of course, alongside equity shareholders, or whether it's venture capital funds or private equity funds or growth capital funds, whatever you want to call it. Yeah, somewhat the same. It's just the color of money, green, dark green, light green. It's kind of the same. But I think it comes from that. I think that's the biggest learning slash takeaway for us. Like, how much are you willing to break and go back to the drawing board? I think that's also very important. I saw something recently. Shopify CEO had said that he thinks himself as a infinite trader. Every year of the stuff he thinks, I did wrong last year. How could I do better? You praise yourself. You know what I did? The last year we grew 35% or 100%. That's great. Okay, how do you better this next year? That comes from the founders. I think that's what we're trying to. We get that call wrong when we're just trying to evaluate on that parameter as like, if you have to ask me one North Star, that's the North Star.
But no, I think one key thing that Samir mentioned is a new term that you can call offensibility. I think you should spend a lot of time thinking about defensibility, but in AI, how are you actually thinking about keeping up is a key theme that I see with both of you guys. Maybe Anuvrat, just going a little deeper on both the AI value creation work, given that you've created a new platform with Premji and you're thinking about value creation with AI, from what I understand. I'm just curious on in US, you see a lot more, you build a SaaS product, got it to a 3-4 million ARR, and then you go buy some services business, which is at 30-35% gross margin, try to double their gross margin with your AI product. That's the traditional, say, what a General Catalyst is doing with their creation playbook. Or, you see a lot more companies in India. I think Pixis has done a great job in creating some of those roll-ups as well, right? Which is fundamentally where I see some AI-driven value creation coming in. But I'm sure there is more, right? I'm just curious to understand, and since you've spent a lot of time here in terms of thinking about value creation, let's start with you. Can you give us some examples on how you're thinking about it, and what are you doing in your current deal that you're working in?
Yeah, I think there is not just one trade here, right? Like, there are, I think, 10 different ways to get to the same outcome. Someone could be buying an old school company, completely changing the management team and kind of hoping to get a more AI first management team and rebuilding the stack from the start. I think that's the camp we are on this particular asset. By the same time, we have done a few of these in the US where it is actually a startup where we've backed and we've kind of done a roll up. Like, it's company X buying 2-3 old companies, but the founders and the CEOs were there from day one. It's not like we found an AI team; they were already an AI guys who had this idea. Again, comes back to my point, like, we finding those founders, or it's less about finding those executives, more about finding the founders who want to go on that ride. And you may just end up owning 60, 70, 80% versus 5%. We are doing both.
Yeah.
So I think there are multiple ways of going about it. You mentioned a few firms who are kind of just saying, I'll pick up a HVAC company and their EBITDA margins are 9%. Hypothetically, I'm throwing numbers at you. I will use AI to take them to 29%. And in that journey, slightly growth will go from say 15% to 25%. Margins go from 9% to 29%. And you make money off that. That's also something that I think will work well. That's not something we are, at least at this point, spending time on. Again, we are evaluating those as well. So I think we are trying those thirds. I think what we definitely have a strong opinion slash viewpoint on is, if you find a company that could reimagine the stack of how things were done in a pre-AI world to a post-AI world. And it's not about taking a CRM and then building AI tools to interact with the CRM. That's one way of doing it. But my view is, you need to go deeper. You need to build your own CRM, hypothetically. That may not work for every industry. That may not be true for every company. So you have to take that call. Like, for example, I give you an example. Like, there is Claude designed to use different types of presentation. It may not be applicable for everyone. Some maybe actually find more value in AI PowerPoint using Copilot. But are you doing that? Are you saying, you know what? We'll make PowerPoint old way. We'll spend 20 hours building it, but now we use an AI to summarize it. And instead of discussing it for 4 hours, we'll summarize it in 20 minutes, and I say 3.5 hours. That's not something that's going to create value. I think what's going to create value is go back to the, as they call it, the root code, and imagine the world again, or imagine your company again from that lens. I think that is these opinions. You may ask this 3 weeks later, or ask me this 4 weeks later. Both of us say different altogether.
No,
Unfortunately, this is how fast AI is going at this point, right? But at least in my head, I think that is the best way to be both offensive and defensive at the same time, because it's not like there is a new tool that has come and that can displace your internal or your product. But at the same time, can you build on top? Because if you own the root code, you can keep building on top. So I think that's what we are doing. That's what at least the platform we are trying to build on housing finance is focused on. Again, Some things you can't compromise on. Like, for example, will we change the risk parameters? The answer is no. How do you look at those risk parameters gets completely changed. It's not going to be just human using a subjective opinion. It has to be a lot more objective. Because again, when you take subjectivity out of some of this stuff, it actually is better. And
Yeah.
sometimes taking objectivity out of it is the right decision. So I think that's the barbell approach. At least we are
But
focusing.
and with, I mean, you talked about we were within your podcast at Lightspeed, and you mentioned some aspects of how you're thinking. Just going one level deeper to understand the framework that we mentioned, right? So when you looked at this deal, and you also did a lot of work in the US with the Lightspeed team and in the buyout as well. One factor was there was a broad thought process on which sector to go and do this first within India, right? You chose housing finance, maybe because it was an asset. I'm just curious to know from a sectorial landscape why what was interesting. Number one, and number two, from the frameworks that we mentioned, I'm just curious to see there's one aspect of underwriting can improve with AI. What other value creation levers are you thinking of that would fundamentally change this business? One. And number two, going forward, how do you use that framework? Is there any other sector that you're deeply looking at right now, studying a lot more
Yeah.
closely?
So we are actually spending time on a lot of sectors. It's just that, at least in India, housing clicked for us better, you could call it. We understood slightly better. Maybe you could say the deal came through the table, or I found the right founding team in Satra and Anil who run the show, or Kamal who's the CTO, or Anil who's and a bunch of other stuffs. Or we found the right partner. I think it is a mix of all of these things coming together. Samir say at any point in time we are looking at 10 things in a day, and hopefully one or two things click in a quarter or a year, and sometimes that doesn't happen for 2 years and the third year it kicks in. So housing for us was somewhat similar. We've been spending a lot of time. It is obviously financial services is one of the largest profit pools in the country. India is very much a developing economy. That means credit is very, very important. That means credit kind of runs the show, whether it's MSME, whether it's lab, whether it's housing, whether it's credit card, unsecured, overdraft, whatever you want to call it, or loan against gold, whatever you want to call it, right? We just felt housing was slightly more secure. And at the same time, we felt it is one sector that has not really seen a technological disruption. The pure reason being it's a very secure sector. I think house is the second last thing you sell in a bad scenario. The last thing you sell is probably your wife, your mom's jewelry, or your ancestral jewelry. This house is probably the second last thing you sell. So I think historically, housing finance has had, thankfully, relatively lesser default rates versus some other sectors. It's a very branch-led model. It's a very people-led model. I think it was the same 15 years ago when I started, or when I think when even Samit started. Housing was exactly the same. It is still the same today. Open 20 branches, 10 people branch, those 200 people will give and go loans. At
Yep.
some point, there would be a collections teams who will go and collect. All obviously the trickier cases. On cases which are doing well, automatic payments will happen. And the only disruption we've seen is cash collection has become Nash. At least we felt, could there be a branch model? Could an RM do, instead of 20 loads, 200? Could collections happen a lot through voice AI and voice agents versus
Got it.
people going in? Could underwriting change a lot? Could underwriting go beyond just income tax filing or GST filing? There are so many alternate sources of data that even I don't know of, but those data points exist. Right? Travel, social media, content, the way you are interacting with, and there are so many tools which are at least enabling a lot of these companies to do that. Account aggregator, blah blah blah. And I think AI is helping us imagine. AI is helping us actually decomplex a lot of those workflows. Could you have your own LOS? Could you have a collection voice agent that works on customer behavior versus depending on 20 collections office? And again, the objective one of it and being a lot objective. I think he felt that actor had the potential to do that. We found a team who believed it. Actually, the team had thought a lot of it through before we met them. Again, we were looking at 10 different ideas, was one of them. So I think that's kind of how it came across for us.
Got it. Oh, super helpful. Thanks for sharing, Anvit. Samit, just on that same point, you mentioned that the value creation lever is yet to be proven. But I'm just curious to understand from spending time on AI, both on offense, which is in value creation for the new investments that you do, one kind of investment that you do. What is the evolving thought process on where you're seeing the biggest levers or any early experiments that you're doing across companies that you're looking at, both by pipeline and portfolio? And second is from a defense standpoint, right? And you mentioned assessing risk of existing portfolio and others on where the disruption. Where do you see that play out? Where do you see some early risks that you are actually working towards? Yeah, just curious to understand thought process on both and early experiments.
Fair question. See, I think the answers are interrelated, right? So no offense is a natural way to not have defense, right? So you end up being obsolete over time, right? So that's the concept. So I don't think one can separate offense from defense. But I think what resonates in, I think what Anuvrat was also saying is just reimagining the stack, right? So in every industry today, there is an opportunity to reimagine the stack, and there are data assets which were undervalued, which today become much more valuable, right? And so, at least from our value creation thesis standpoint, like that has been the focus area. How do we, like we were discussing earlier, right? This has to be driven from the top, right? There has to be evangelism from the top, because there is just so much noise around AI, so many platforms, so many things one could do, right? So you have to channelize your energy. And so our focus really is to drive that governance and thought partnership in our companies, so that they can prioritize where they reimagine the stack, where they already have some data assets which were overlooked or under monetized, that they can monetize, right? I mean, one example, so we own a large portfolio of tech services companies, and one of the things that, as industries are going through this adoption, there is banking, healthcare, many industries in the US who are thinking through how do we adopt. The first, even before they start reimagining the stack, the quality of data itself is today not where it should be if you really want to run an agentic process. And so the first wave of opportunity we are seeing is around data engineering, data enrichment, anything that touches the data value chain. And so our focus is that can we use some of these short term ideas and long term ideas. In the short term it'll be data, but that makes a foot in the door for everything else that comes out of it, right? Because once you understand the data, then you can help agentify a lot of things. The advantage we are playing on is that we have the largest pool of technical talent in India, right? 2.5 million STEM graduates every year. Somebody who's technically trained is better equipped with AI. Somebody who's not technically trained is weaker equipped with AI. Right? That's the bedrock of this belief. But that's where our focus area is, right? So I was able to give you the sense.
And, Samir, and we'll come to Anirudh as well. Once you've proven that model, let's say, increasing your EBITDA from the example Anuvrat gave on HVAC services, 29%, or the experiments in a housing finance company to actually say you're seeing real margin improvements, both at the gross and at the net level. We see some tuck-in acquisitions happening where you can go and then buy smaller, tuck-in opportunities, given that you have a good technology liver on top where you actually did this at the services business and proven it works. I'm curious, Amir, have you seen that play out with any of a portfolio or pipeline companies you're meeting? We see that play out in some of the venture-backed companies right now, where they've proven a software product and they're trying it out. We have a company called 5C Network in Capria's portfolio. It's a teleradiology business where they used to be at a 35% gross margin. They got to a 60%, and now they're figuring out some acquisition in the US. So I'm just curious, are you seeing that fundamental tuck-in roll-up opportunity change or play it out in India? I'm sure there's some stuff happening in the US.
No, definitely. Like we are 100% seeing that. I think there is at a market level, once you figured out the solution, M&A is giving you the right MSAs and the right client relationships to then go and deploy it in. And so we see that increasingly happen. I think one of the other trends that we are seeing is integration has become very easy. So, we own a software company, we were acquiring, they were evaluating a target, let's say a couple of years back. Now they're revisiting that. That target is on a completely different platform. Now with AI, you can complete the platform migration in just under a month. And so, tucking in many things becomes easier.
Yes,
It's a dual approach. On one end, if you have the right solution, then a bolt-on helps you accelerate the real estate on which you can deploy that solution. And then at the same time, wherever there were barriers in the past to integrating, many of those barriers have come down because AI just accelerates the pace at which you can integrate two businesses.
Got it. No, that helps. And with one thing, just doubling down, you mentioned housing finance as a bedrock, right? But given that both of you have global ICs and you see deals across other markets and India, is there some, apart from the engineering services, tech services that we talked about, where we have a great engineering talent pool, is there any other sector that's seeing global excitement? There's a huge of consumption story that's playing out, but I'm just curious about what other sectors, and since you spend time across sectors, it's super exciting that you're actively spending time on.
I think it's content changing. I think country by country, I think US is slightly in a different paradigm, I would say. And fortunately for them, unfortunately for us, quite far ahead of at least where we are in this part of the world. I think US, I am seeing stuff happening on energy, how you use hydrogen fuels better, how you use old rocket fuels better, how you kind of power these data centers more and more efficiently and faster. There is this company, I'm sure everyone's heard of them, Bloom Energy. They're building these oxide cells, the stocks tearing at a different level. Again, that kind of stuff is happening there. Robotics, I think, is something that is happening a lot in the US. Again, early days, but I think we've gone from a world where could robots do a few things to can robots do everything thanks to AI? Because now what has happened is now you can there is this technology that can constant learn and relearn, and kind of keep doing it on a loop, which was not there 10, 15 years ago. I think 10 years ago, it was a lot more about what all inputs can you do. And robots could only do those 10 tasks which you teach them. I don't think that's true anymore. Now, again, when the theory meets practical, you'll see a lot of that change. We are seeing that in Korea, seeing that in Japan. Robotics is a big thing there. Consumer AI, content AI is very, very big, for example, in Korea and Japan. We are seeing a lot of stuff happening with AI content, anime. Okay, very kid-oriented content because those are very large. There, I think in India, where we are, I think we will be large consumers of AI versus large producers of AI. I think the LLM or the model layer, there are a few players. We have one in India, but again, 7 of them outside are in the US who raise hundreds of billions of dollars. So I think India would have a lot of consumption. So we are going to see, like I'll give you an example. The stuff we are seeing is a lot of stuff happening in voice because India historically has been a big BPO slash call center market. So before someone else removes you, could you improve that yourself and right be defensible there? I think AI services is a thing which is again India in a very IT service focused economy. I think Samir can answer that a lot better. He's a lot more deeper there than I am. But again, could you do this in a more productive manner before AI comes and replaces you? That's what I was saying, right? Like you have to kind of reimagine the stack. You have to go back to the drawing board, finally rebuild yourself. I think that's where India is going to be. What we are also seeing is, I think we are seeing a lot of maybe I don't want to simplify it by saying it margin optimization because it kind of really takes away from the hard work that is happening. But I am seeing across my portfolio companies, time to ship and produce dramatically change. Now, what that really helps you is the end output is, yeah, margin is better and output is better. But again, it's a very shallow way of looking at it. It really helps you instead of having a 1 to 10 take 10 weeks. V1 to V10 probably takes maybe hopefully 10 hours or maybe something like that. And you are understanding your customer needs a lot better. You're shipping a lot more refined product. You're doing it much faster and much sooner. So you get feedback and kind of revise it and go from V10 to V20 much sooner. Right. So I think we are seeing a lot of that happen in India. That's going to obviously replace a lot of, you want to call it other tools and build it all in house. But you'll also see birth of new tools. So I think we are seeing a lot of that in this part of the world. Hence, like for example, using an example, I think some spoke about how software companies want to reimagine their sales process, right? Like for example, earlier, a sales rep would go and sell only 5 products, right? He or she would make those notes, put them in a CRM manually, come back. That in itself may take with an efficient sales guy maybe 5 hours, with an inefficient sales guy probably a day or 2 days, could be anything. Now there are AI note takers, there are AI workflows. You are in a meeting, take the notes, put this in the CRM, give the output. It automatically goes to the processing guy or the account management guy. There is memory on the same client. I'll give you an example in wealth, right? For example, RM talks to the same client and ARM talks to the same client. And execution guy does execution of the same client. Now, in a AI, three people have different knowledge of this client. A or may not speak to them each other on a continuous basis. There may be some break in the way knowledge is shared. In the world of AI, all of that is actually on an AI stack memory. It doesn't matter if they speak to each other or not. The system knows. So tomorrow, for example, the way I think of like today, a wealth business is a lot more dependent on RM. Could AI completely reimagine it? Could it take up the strength of RMs and make it the strength of branding? That would completely change how wealth management is done in every single country. Now, it's possible on theory, but again, as I said, theory meets practical. So we are going to see a lot of that. So again, you will see a lot of consumption services oriented economy part of the world. And we hopefully, as Samir said, youngest population, largest population, fairly hungry population, per capita is still quite far behind where US or China is. So I think I would, in an ideal world for someone like me, and I think it's also true for Samir, would really like to see our per capita growth go much faster, driven by AI. I think that's what we are hoping to see.
Got it. No, Anirudh, you touched upon, from thesis to execution, things breaking. And given that you're entering the stage where you start to own larger percentage than you typically own at growth, Viva as an example, and maybe you'll do a lot more of about 80-90% ownership as well. I'm just curious, how are you spending time on portfolio management? Like, there's two things you mentioned. One was AI doing efficiency for salesman, becoming better salesman, and so on others. And second was intelligence on people not speaking to each other, actually learning from each other, right? So two key areas that I can spot.
Yeah.
When you're spending time with the new management team that you've assessed already, given the capital, what are the key things that you're really, focusing on to make sure we're on the right track from a portfolio management standpoint?
I think it is a function of what you promise and what you deliver, and it goes beyond revenue EBITDA. I'm not just talking that. Of course, then again, you have to break the conversation into input and output, right? That kind of is the output. We said in 2 years we'll do X million dollars in revenue with Y% EBITDA. Yeah, okay. How do you deliver? That's kind of an output. I think what we are spending time on is understanding this was our product roadmap over the next 6 weeks or over the next 6 months. And if I'm catching up with a particular management on a particular topic, let's say a 3 quarter, they had a 4 quarter product roadmap. Earlier, may not indulge not on that, but now I am. Because again, AI is helping me understand these things better. AI is helping me challenge these guys better. Their product velocity has increased a lot. The shipping has increased a lot. I am spending a lot more time being technical. Earlier, I was not coding. In the world of coding, I was not spending any time on that. I'm not a computer science guy by background. I'm a commerce guy by background. But now I am spending time on a lot on vibe coding or AI agents. So I kind of understand, may not obviously not as well as let's call a CTO doing it, but at least 10%. Earlier it was 2%, for example, right? So I think we are spending a lot more time in kind of mapping it, spending time. I'll give you something even as say as I don't spend time on making MISs anymore, or even the associates in our team are not making MISs anymore. Like you should be smart enough with AI tool to kind of have their output ready when the MIS Excel comes to you versus, going and cleaning up the Excel. Or for example, I'll give you another one. Like we should not like we don't spend time on making these tens of models anymore. Like I think those outputs are happening a lot faster and a lot of them are more automated and AI driven. You could have conversations on the go. Like, for example, I wanted to understand an impact of, I'll give you a live example, right? I wanted to understand the impact of a certain debt pay down or a certain debt schedule. Early 2 years ago, this conversation cannot build on an Excel model. You don't actually need a more. Cloud Artifact can do it actually far better than an Excel model. Again, these small ideas add up. These small items add up. So I think we are having a lot more deeper, enriching conversations with our management, pushing them, understanding from them. At the same time, these tasks which could take away 8 to 12 hours of our lives now get changes as you grow the system, but there is always some task. There is always some grunt work which you need to do. I'm getting a lot of my time back. I'm getting a lot of my time back from that. For now, I don't know if I'm doing deep thinking or not. That is a problem. But I have the time to do a lot more deep thinking than I had 5 years. I'll Samir answer that.
I think just on that point, like we have this concept of, like micro productivity and macro productivity. And we are seeing a lot of micro productivity, right? So you have 10 people in a team, everybody is 20% more productive. They have 20% more time. But that doesn't mean that you can either take one person out to deliver something else, right? You still need the 10-member team. So it's a little bit of that belief curve. And how do you get to macro productivity over time where all of it gets, used for somewhere in the business? I think that's a question.
So we would love to touch upon the portfolio management a little bit. But before that, on the productivity piece, right? At least for me, very similar to Anuvrat, used to spend a lot of time in all those, everything from modeling to taking notes to learning. All those things have now, thanks to Claude and ChatGPT and all changed. Even podcasts, I think earlier, it takes a lot more effort to actually sit and edit and create a thumbnail and all. Now, thanks to Riverside, all this is automated. As soon as the episode is done, gets done in half an hour, right? And which is why I'm doing this more often right now. So I see a lot more leverage coming in, and I've been spending a lot more time talking to founders and talking to investors. So lot more time to actually spend on ground, build relationships, get on ground depth is how at least early stage venture and business has been changing. Samir talked about how their pipeline is fundamentally changing and surfacing new opportunities. And we talked about getting a lot more time back. And I'm just curious, from your sourcing standpoint, which seems to be, again, at least in a growth stage, I believe, meeting new interesting founders at the right time early on, very, very important. Is there any AI leverage you see that's playing out? Is there any AI leverage that you're seeing play out?
I think maybe take a stab at it. Maybe I haven't done a better job at it. At least few of my colleagues, yes. I know two of my colleagues that have kind of built a tool on top of what LinkedIn is. And again, I'm talking more just strategy perspective. I think for me, Samir, slightly different than what Venture is.
Yeah.
Because like a lot of executives, like for example, someone leaves Flipkart. You want to be the first. WhatsApp in his phone. That's not something I do, or I'm sure even Samir doesn't do that. But I think venture guys do that. So I think few of my colleagues are really getting better at that. But I think at least for me on the sourcing aspect, I think what's happened a bit is earlier, I think I used to walk into those company meetings. I think what's helped me a lot is that I used to always read up before any meeting. For example, if I am meeting now, Zepto is a portfolio company, but before meeting Zepto in a pre world, I would spend half an hour trying to understand what I from the company. That's it, right? Now, I think I built like a mini AI agent that can kind of go on Twitter, Reddit, news articles, website, past interactions in our CRM, past interactions I may have had with the same company because again, you may meet a company and you may not invest for the first time. You're going to track their company for a while. We do that a lot. Meet a Series B company, get in at Series B. So I think that knowledge base and kind of absorbing that knowledge and using that knowledge to be better informed before I walk into a conversation with a CXO or a founder, I think AI has changed that game for me completely. And I have a pre-meeting dossier kind of an agent. Again, I don't know how good it is, but for me, it's kind of like content I iterate it a bit before I make any come. Even with my current CXOs, managements, I may not always remember what happened in the last meeting. Or like, for example, we spoke in May, we would have achieved this, but actually we spoke about this last November. I may not fully remember the nitty-gritties of it, but it is logged somewhere in my notes, somewhere in my granola, somewhere in my CRM, somewhere in the Excel MISs over the last 6, 8 months. AI is helping me summarize, make it a lot more readable, contextualizing it a lot, doing the same thing before I meet a new company. I just don't depend on the company's website anymore. Or even if I'm meeting a executive who may be leaving and, just reached out, I know a lot more about that person than just ex-VP at Y company, right? You must have spoken in some podcasts, some panels, must have done some posts, must have put something on Twitter. AI is helping me get access to that, contextualize that a lot. So I think that's really helped me. I think sourcing has become more, the quality and the efficiency has really improved for me,
Yeah.
not the volume at least.
Got it. Lot more intelligence from all your conversation, being able to collect that better. And Samir, on the portfolio bit, I think Anuvrat touched upon IT services, and you touched upon how data is an emerging opportunity for a lot of the portfolio companies. There's one aspect of a lot of companies wanting to do AI use cases and new segment of opportunity opening up for tech services business. But also the other aspect of the cost to build software dropping, the time to build software dropping, and that kind of fundamentally affecting the way people used to build clients, right? I'm just curious to know how are you thinking about that portfolio management bit in terms of the disruption risk within tech service systems? I'm sure you spend a lot of time, but just curious to know your thoughts on that.
See, I think for us, ultimately, we are relying on the numbers and the fundamentals. And for our companies, for example, we see the fundamentals trend in a very, very strong uptick direction this year versus last year. One of the things is, like obviously from a 100 feet level, you feel like everything will be disrupted. But then when you look at the enterprises, and I'm talking about, let's say, Fortune 2000, the debt, all software that has been built in the last 7 years, that's about $10 trillion. And all of that needs to be modernized by somebody, right? So doing greenfield development with AI is very easy. I can spin up a new website, I can start a new use case. But doing something brownfield, which touches 5 other things which were built, I don't know how many years ago. I mean, if you look at the travel industry, I think Amadeus was built 60 years ago. Travelport was built like 40 years ago. So they are all running on systems, and these are critical systems, right? You can't shut off Amadeus for a day just to upgrade it because the world's airlines operate on that. So the enterprise adoption generally, takes time. It requires help. And we are increasingly trying to make sure that, our companies are focused on getting that right offering to the right client. So we have a big forum of CEOs where, on a regular basis, we exchange ideas, like all the CEOs exchange ideas, because ultimately it's top-down driven. We have to run many experiments. Some will succeed, some will not succeed. And the ones which succeed, you scale up quickly, right? So that's the model of today. And that's what we are prioritizing in our portfolio companies so that, people try out things fast as different waves of technology comes out. And the big use cases are then sort of generalized throughout the portfolio.
Got it. I think we're almost at time. Just one last question before we close. Amit and Samir, both you guys, when you fundamentally hire a new team, or you have trusted a new management team to run this business, and you in a buyout business you own 80, 90, or even 100% of that business, does that aspect of making sure the incentives are in place for the management team for the long haul, right? Maybe the 4 to 5 years. Because I've seen people do it differently. Some do cash out at milestone, to very different models that you see, right? I'm just curious, and since this is AI first founders, they have an opportunity to go and build something ground up, own 80, 90% for themselves, and see that through as well, right? So I'm just curious, when you meet this management team where you own 80-90% or 100% of the business, are you thinking about making sure that they have the incentives and they are in here at least for the next 5 to 10 years or so? We have seen in some cases where you're acquiring a small scale services business. I'm talking about sub 10 million revenue business where the founder moves on and some clients leave with the founder because the largest relationship is there, right? So there's a real risk of the founding team moving on, so on and so forth. So just curious on from whenever you assess opportunities for buyout, when the AI wave, lot more capital coming into startup, are we making sure they stick on for 5-6 years or more?
So yeah, I think see, for us, most of our investments tend to be in companies which are slightly more mature, and generally we try and prioritize companies which cater to Fortune 2000 and not really mid market, because in mid market switching costs are easier. These are smaller companies; they may switch for very small changes in cost and those kind of things. So ultimately, once you've tested the client relationships, they are at sort of durable relationships which have been built over many years. Not seen any client churn with change in CEO. Like in many cases, like our clients don't even know who is the CEO of the company, right? Like you buy services from Xerox, you may not even know who's the CEO of Xerox. You may still have their printers. So that's one insight which has helped us. But at the same time, we've always aligned incentives to a long-term plan. The whole thesis is built around value creation. So whether it's the same set of founders if they want to continue, or it's a new team, let's say if the founders don't want to continue, in either of those situations, we always align on a framework on how do we do it in the first year. Governance framework is called BMS. And everything is aligned to that. So there is 100% alignment between us as well as whoever is running the business.
Got it. And Ruth, for you, now that you're
Yeah, so I think, right, you like Samir kind of answered it. I think for us, at least the way I've thought about it is, if you don't have skin in the game, it just breaks. And I think it doesn't matter if you own 10% or 90-80%. Like again, everyone in the system needs to have skin in the game, and more so the executives or the people running the company, whether you want to call it the founder or the CEO or the CTO, whatever you want to call it, right? I think I don't think that has anything to do with AI in my opinion, right? If for example at some point you own 90% of a company, and let's call it the CEO owns 0.2%, and he knows that this company is absolute game changing and is doing something which is game, like it is building a product which has not happened before. It is doing it at a speed that has not happened before. He or she will not want to own 0.2%, and even you will not want that person to own 0.2%. Forget taking clients. That person can go on and build that exact same company much faster, right? It's not just about clients anymore, right? So I think the skin in the game is I don't think it has. I think some of these things are very human law kind of a thing. If you don't have skin in the game, why would you do this? Right. So I think that aspect remains as it is. And I think what Samir said, right, in mature companies, shifting clients gets hard. I think that's where the moat comes from, right? So and again, right, like the funny part is, finally I think there is a technology, just to maybe relatively add as a counter to what just the Samir said. In 2-3 years with AI, the switching costs may both increase and decrease at the same time. And that is the defensibility in your product, right? For example, if you are Claude or ChatGPT, I think switching costs are high, right? But for example, if you are a marketing CRM, switching costs 2 years ago were very high. Today, I think it's zero, absolutely zero. My understanding, and I'm seeing my portfolio companies change their CRMs, build their own, get a better one, or for example, designing tools. The switching cost is absolutely probably negative. Not switching is it's a bad thing than switching in some of these tools. But for example, if you are a RCM for a hospital, I think it's a lot less about switching costs. It's a lot more about who is the right person to run this company, and do we have the right person to run this company, and does that person have the right incentives to run it in a manner that is a win-win for everyone, right? So I think that's how we think of it.
good. No, I think thanks a lot, both of you. A little over time. Thanks a lot for making time. I learned a lot. I'm sure both as founders watching this will learn a lot. Hope to see you in some other episode when we host it.
No, thank you for having us and taking out a Sunday. Thanks, Amir, for joining. Really enjoyed the chat.
No, likewise. Thank you for having us. Really enjoyed the chat.